Peabody Energy, the world's largest private sector coal producer, has filed for Chapter 11 bankruptcy protection in the US. It's become the latest in a long line of recent bankruptcies in the mining industry and in the coal industry in particular. The company is not shutting down. Chapter 11 bankruptcy means it can continue operations while restructuring its debts. Glenn Kellow, the chief executive, and the rest of the management team will remain in place. Wages and salaries will still be paid, and so on. A group of lenders, led by Citigroup, has agreed to provide $800 million of financing to keep the mines open. But shareholders will lose all their money, whatever they had left. The shares had already lost 97% of their value in the past year. The coal industry in the US and worldwide has been going through a terrible time, and government policy is only marginally responsible. The two killers for Peabody have been cheap natural gas in the US and the global commodity slump. At less than $2 per million British thermal units in the US, gas has become the most cost-effective fuel for power generation. Coal's share of US electricity generation has dropped from 45% in 2010 to just 33% last year. Tighter environmental regulations have contributed, but the most important factor has been that cheap gas. US miners had hoped that rising exports would make up for a weak home market, but the commodity slump has dashed those hopes. US coal exports dropped more than 40% between 2013 and 2015. But if President Barack Obama's alleged war on coal has been of secondary importance so far, it is becoming more significant. His Clean Power Plan, intended to cut carbon dioxide emissions from electricity, is casting a shadow over coal's future. The plan faces further hurdles. It's being challenged in court, and a Republican president would surely scrap it. But if it remains in place, it'll drive a further decline in the use of coal to generate electricity in the US. At the beginning of the decade, many American mining executives were hopeful that coal was a one-way long-term bet. Industrialization in China seemed to be driving a supercycle of strong growth in demand and rising prices for commodities. Several US companies tried to capitalize on that with ambitious acquisitions to position themselves for that future growth. In 2011, Peabody paid $5 billion to buy MacArthur Coal of Australia, a specialist in high-quality coal used for making steel. The trust in that supercycle turned out to be misplaced, however. Today, the price of Australian coal for steelmaking is about a quarter of its peak in 2011. The cash used to buy MacArthur accounts for the bulk of Peabody's $6 billion debt. The US operations still generate cash, even in this very difficult environment. They just couldn't cope with the burden of debt that they had to carry.